So with that, let's get started with today's State of the Markets, Market Matters here on May 14th. Here is a quick agenda where we're going to hit just some macro or big picture updates driving the economy and some thoughts which do have some impact on our investment positioning. We're starting to contemplate how some of these things might be evolving as the year goes on. So with that as a backdrop, let's get started. Just thought it would be useful to have a picture of spring because certainly, at least at the market level, spring certainly definitely seems to be in the air, and want to reflect that with a beautiful picture of Atlanta in springtime. So for those who have tuned into this podcast or webcast, you'll know that we do find some value in referring back to the underlying components of the economy. Those are the services economy, that's that purple line, and the manufacturing economy, which is in the orange line. And just for reference, this is the ISM services and manufacturing indices. Any value that's above 50 indicates expansion. Any value below 50 indicates contraction. And what we notice here, and I think this is kind of just the great sorting out that continues to occur post-COVID, and even actually after a significant rise in interest rates over the last couple of years, and that is we've kind of settled into this steady state where we're not necessarily contracting, we're not necessarily expanding too meaningfully. And I think that's exactly the right recipe for what's needed right now with the markets, because if the economy as a whole were expanding too rapidly as it was back in 21, then this would lead to a pretty substantial bout of inflation, because more demand for goods and services creates constraints of various types, leading to inflation. And I think this not too hot, not too cold status that we're in, at least from the components of the economy, indicate a pretty good Goldilocks type scenario to be in. Not to say that we can't move lower from here or higher from here, but just as we settle into kind of a more normalized range, we're kind of at about the neutral level. And I think that's a pretty good starting point for the overall underpinnings of the U.S. economy. Globally, that picture is a bit different, where the U.S. currently is, I would say, the cleanest dirty shirt, if you will. Places like Canada and parts of Europe are in contraction, no doubt about it. China is decelerating, but we'll touch on that here in just a moment. Going back to, comments I just made about, U.S. being kind of the cleanest dirty shirt, that's also reflected in the strength of our currency. You can see the U.S. dollar index. This is a basket of currencies versus the dollar. And if this line is going up, or the value is going up, that means the dollar is strengthening versus our trading partners. Think about, continental Europe, Japan, Australia, Switzerland, things of that nature. And I only point this out because for two reasons. Number one is I have gotten the question quite a bit, where there's clients that are concerned about our level of spending and the debt service load at the federal level. So certainly we are, aware of that dynamic that's going on. And I think reason I keep showing this chart is because we will know when this level of spending and debt and deficit is becoming an issue in the U.S. when our currency starts to decline. And not just, by a small amount, I'm talking about like by a pretty meaningful amount. So we've laid out target levels to start to raise concern. And I think for us, the first level of a dollar index that would raise some concern, if we got there relatively quickly, would be somewhere between that 90-ish level in the dollar index, because that would represent a pretty decent move lower, roughly 10% or so. And it all depends on how we get there. That's one reason we show this chart. The other reason we show this chart is to point out that the higher this level goes, the dollar goes relative to our trading partners, the more friction gets put into the global financial system, because there are many commodities that are denominated in dollars only. So think oil, for one. That is a commodity that's dominated by the dollar market system. Gold, things of that nature, copper. And the higher this dollar level goes, the more unaffordable some of these commodities get in international markets. And so there's also international governments that or corporations that borrow in dollars as well. And if you're earning in local currency, but having to repay in a stronger currency, that creates a negative economic impact. And so this is why when the dollar is rising, typically in advance of potentially recessionary conditions, that's why people tend to pay attention, because if this dollar gets too strong, and we think the level it's at right now is probably fine for now, but if we go too much higher from here, then we'll have to start getting a little more concerned about how much further the rally and risk assets can go from here. But for right now, we're again kind of in this Goldilocks scenario where it's not too hot, not too cold. One thing that is supporting the economy right now that should be noted is the pretty supported move in housing and house prices. And what you see here is the Case-Shiller, the purple line is the Case-Shiller 20 home price index, showed on a year-over-year basis. And what you see is, and this is as of February, so you have to be mindful that there has been a couple of additional months of price performance in housing. But as of February, according to Case-Shiller, house prices have rose 7.3% year over year. And that's up from in contraction at the beginning and middle part of 2023. And the reason we point out housing, because housing is generally a source of wealth for the majority of Americans. And it creates what's called a wealth effect, which I certainly would ascribe to. The higher value your home gets, the more free consumers feel they can spend more. And I would point out that house prices are rising 7.3%, despite the fact that the average mortgage rate now is over 7%. And you might think that that's a little strange, because in prior cycles, as mortgage rates and interest rates went up, that killed financial assets. And it's, I think, emblematic of the time we're in right now, where, well, I'll show you here on the next slide why I think this isn't as big of an issue. This next slide shows you the number of homes that are mortgage free. So this number has evolved quite a bit since the financial crisis. I do think this is a post-GFC or post-financial crisis 2008 scenario or behavior modification, where going into the financial crisis of 2007, 2008, people were much more willing to carry mortgages because they felt pretty confident with the economy and jobs market and the like. And then, of course, the bottom fell out in 2009, and that changed the mentality. Where you can see number of houses that were mortgage free in 2010 was 33%. As of the end of last year, 2023, we're roughly at 40%. So it's a pretty meaningful number of homes that no longer carry a mortgage. And furthermore, the average mortgage that's outstanding right now carries an interest rate of 3.5%. So yes, it is a tricky situation for new home buyers, no question about it. The way I think most home buyers that are newer to the scene are adapting to that is by putting down a lot more as a down payment versus taking on a mortgage. But this is also, I think, just helps support the idea that there is a wealth effect that's real. There is actual savings that has been built up in this asset class, and people are actually spending it via consumer spending and other items. And this obviously would apply to the middle income and higher brackets of consumer spending. Lower income brackets, of course, we know are by way of credit card defaults or car loan defaults, are starting to be impacted by the higher rates phenomenon. But by and large, a vast majority of the spending occurs at those upper echelons. And for the time being, this is pretty well supported by what I believe to be is a pretty meaningful wealth effect. One thing to point out, though, I've shown this chart a couple of times, and I don't generally show it too often, but I do think it's important to just point out, and we talk about this in our investment team meetings quite a bit, is there is some complacency starting to creep in the markets, no question about it. We want to make sure we're aware of market dynamics as they change, because certainly, as prior periods of history would suggest, as complacency builds, that just lends to sharper sell-offs when an event actually occurs. And what you're seeing here are two things that are kind of measures of risk. The purple line is the CBOE's volatility index, or the VIX index. By way of reference, the average level of the VIX over the last 30 years has been about 16. We're now at 13, and this level of VIX actually gets us back to, call it 2015 levels of volatility overall for the stock market. The yellow line is a high yield spreads, so how much additional compensation over a treasury is required to buy a high yield bond. And generally, the more this line comes down, the more willing people are to take on risk, and the less discerning people get about credit quality that they're taking on. And why would they do that? It's because they feel the economy is strong and that the probability of a default is low. So certainly, people are voting with their feet and saying, "Hey, we're comfortable taking on high yield risk right now because the economy looks good." All that to say is that we want to be aware that some of these risk measures are getting to levels that seem a little bit complacent, and that has, I think, kicked off more of a research effort for us on our part to really I try to identify strategies or opportunities, whether they be single stock or asset classes or strategies that might benefit from a re-rating of either the stock market volatility, bond market volatility, or spreads widening. So that just puts us on a little bit of an alert, but nothing, again, too meaningful at the moment, just worth pointing out. I showed this chart at the beginning of the year because the year was already shaping up to be a bit of a volatile year from a markets standpoint, given that rates had come off quite a bit, starting in October of last year, and we coming off a pretty solid year for the equity market. We're about to enter a pretty meaningful election season, not here in the U.S., as you can see that's happening in November, but also the June-July timeframe is going to be pretty active internationally for government elections. And so, whenever there's lots of political change at hand, you just want to be mindful that could be a reason why volatility is picking up, and not be thrown off by any false flags or things of that nature. But I guess we just point this out to say the election season globally is getting into a very active period, and that we're obviously bracing for higher levels of volatility, trying not to get shook away from our positions too easily, because this is going to be a dynamic that's going to be with us for the next few months. And so now we get to our themes. We have changed some of the wordage and verbiage here and some of the ideas here. We'll talk about this politics and financial markets. We've touched on this a few times already, but worth noting, and I've got a slide that I think sums that up pretty nicely. The big risk for the year, of course, as we pointed out, starting in January, was that the Fed wasn't going to do nearly as much as the market thought they were going to do. That has played out to our kind of understanding. However, it's not necessarily been very super detrimental to risk markets. So with the S&P now where we are at plus 9.5 or so, bond market only down call it 2%, commodities higher by a decent amount. That has not been the underwhelming response that we would have expected if the Fed was supposed to on January 1 cut rates 7 times this year. Now the Fed is expected to cut rates 1 to 2 times. Our belief continues to be that we'll be lucky if we get 1 this year at all, if any, and that is our base case that we're operating off of. So that has implications for certainly rebalancing process, types of stocks maybe we're looking at, and also fixed income positioning, because I think there is still a risk that with unemployment so low, and the Fed really wanting to cut rates, if they do cut unnecessarily, that they could risk a second wave of inflation cropping up, just like what happened in the mid-1970s. We do recognize there are, parts of the market or economy that are not performing as well. We talked about a few of those. Regional banks still are pretty weak. Real estate still very weak as they work through refinancing issues. Consumer-oriented segments are tapering off. But I think it's important to note there are still big offsets to that weakness via things like fiscal spending from the government, CHIPS Act, CARES Act. These are all things that are just starting to become impactful to the overall aggregate spend. And we shouldn't lose sight of that because there's quite a bit of cross currents. And then the new one we just put on here just to point it out, we talked about it a little bit, is that complacency is creeping in. We want to make sure we're optimizing our portfolio to take advantage of any sharp, sell-offs or volatility adjustments. And I think that's certainly a top of mind for our research priority at the moment. And I should just point out, just as we normally do, if you do have any questions, feel free to drop those in the chat. I'll try to grab those as we go along. You'll notice here again, our positioning remains relatively the same as it was at the beginning of Q1, where we have a US overweight still, dramatic US overweight relative to maybe the global portfolio, still very much large cap oriented, although we did add a mid cap position, which has been actually pretty meaningful in our asset allocation portfolios. It's been done quite well for us. Mid cap positions in our equity strategy on the dividend strategy side have done really well for us as well too. And these are just some of the small modifications that can really add to return over time. But you have to be watching for those opportunities as they pop up. Developed markets internationally still are an underweight for us. There is still continuing to be a bull market in Japan that broke out of its 30-year range last year. And I'm a believer that, breaking the new highs is a important signal to keep an eye on. So Japan continues to press higher as corporate reforms, governmental reforms, interest rates finally rising for the first time in a long time, all build to the Japan story. Not that we're going to be making any substantial or meaningful allocations there, but I think it's just also represents a tailwind to global markets that could be beneficial not only to U.S. companies but to other equity positions that we have. And then a new addition that we'll touch on as well is that Chinese equities appear to be bottoming as opposed to kind of falling off a cliff earlier in the year in Q1. The fact that China's been able to stabilize their financial markets, somewhat stabilize their property market, I think goes a long way to removing some of the exogenous risk that may have previously been there emanating out of Asia. There's still a big risk, of course, that China decides to go it alone and devalue their currency, which would have, I think, wide-ranging impacts to equity portfolios, but it's still a relatively low probability. On the bond side, we still the song remains the same here. Resilient inflation means that we have to stay short in duration, and so if we were to look into your account, if the bond market is down roughly 2% or so this year at the index level, our portfolios are still likely either right around the break-even point or slightly positive, depending on what orientation, taxable versus tax exempt. And we're really happy with that outcome so far. We'll remain in a short duration positioning until we feel like compensation for taking on longer term bond risk is there. Currently, it's not there yet. In previous market matters, we've laid out levels where that could be worth looking at. And I think when we looked at it last year, based on volatility, it's probably around the 5.5% on the 10-year is when duration starts to look interesting again. Finally, I just wanted to point out alternative strategies, whether it be liquid alternatives or private alternatives, are actually having a pretty good year. Coming off a pretty decent year last year with nice diversification benefits. This year is the exact same situation where things like trend following have done real well for us this year so far. We'll continue those efforts on that front. REITs, we're still at a neutral. We probably should mark those at an underweight. The public REITs still are trying to work out of what is dropping vacancies and worsening credit conditions on the real estate side. So we're kind of indifferent on that at the moment, but still have no exposure. And then on the private side, long short equity exposure or long short equity strategies, like the type we are just launching via iCapital, we think are set up exceptionally well to have post good performance despite if markets sell off, because theoretically if you have both long and short positions, the market sells off, those could be doing worse than the overall market if you select right, in which case it's possible to have a positive return in a negative otherwise market. But going back to the liquid markets, we still aren't terribly concerned with where the stock market is trading right now. The S&P appears pretty well oriented, even at the current valuation level, because earnings continue to drive the market higher. Now, I mean, I would say we are, I think, at the level or roughly the percentage return that we thought we would get for the whole year. So call it, 9 to 11%, I think is what we were expecting. We're right about 10 for right now. But the reason the market is higher, despite the fact that interest rates have actually gone up this year from 3.9 on January 1st to 4.5 today, is because of this right here, what you're seeing right here. And this is the earnings picture by sector. And you can see the S&P coming into Q1 on March 31st. Most analysts had expected earnings growth in the S&P to be 3.5%. With roughly 85% of the S&P having reported so far, we're seeing that the S&P companies are actually showing earnings growth of 5%. So this is a nice upside surprise. You can see where this is coming from as well, coming from places like communication services, utilities of all places, which is very bizarre, but we'll touch on that in just a moment. IT is surprisingly upside, even real estate, industrials. This is a big delta, and showing that what was once thought to be a negative return, earnings growth in that sector showing nicely positive, and financials. And then we'll see how that translates into actual performance. There's very few sectors that are actually underperforming the expectation right now. And as we know, markets are forward-looking, and therefore it becomes an expectations game. And right now, the sectors, stocks in the market are all beating expectations. So that's why we've, I think, been able to push to levels that we're at right now. Another positive dynamic we got right now in the market in the S&P is that there is actually differentiation occurring within the sectors, in the sector returns. So I showed you the earnings picture that is telling you one story. The other story is actually how performance has evolved, and that's what these squiggly lines are all telling you. But would you be surprised to know, and I certainly would not have predicted this, that the best performing sector so far this year, despite the fact that interest rates have risen, is actually right here, utilities. Utilities are the best performing sector in the S&P through yesterday, I believe, or this morning. And why is that? Well, I think there is now this is after underperforming pretty decently all the way through April. And utilities have had a pretty meaningful uplift in their price performance because in their earnings reports, a lot of utilities are reporting massive demand growth for electricity usage, primarily as a result of data centers, new data centers that are contemplated being constructed as a result of AI and large language model demand. So really fascinating that utilities are leading the market higher. I would not have expected this, but this is again why I think this is a rally or a market that is not necessarily as at risk as some people might think it would be, because you've got non-traditional sectors leading the market now, whereas previously it was technology. Technology, you can see, is probably fourth or fifth best performing sector here at 7.4. It's the XLK. And you've also got, some of the more interest rate sensitive sectors like financials doing pretty well now too, because of maybe the expectation that the Fed will cut rates and the yield curve will start to normalize. What's not doing well at the market level is maybe things that you might expect. Consumer discretionary, just look no further than Home Depot and their earnings number this morning, showing 6 consecutive quarters of slower sales growth. So that's certainly reflecting, I think, lower expectations in the future. Real estate, that continues to be an ongoing evolving asset class as refinancings keep occurring, vacancy levels start to normalize, rents start to normalize. And then I think a little bit surprisingly is healthcare. Healthcare has been the third worst performing sector so far this year, really on the back of some very large pharma companies having some underwhelming earnings expectations. And there's of course lots of differentiation though within healthcare. It's not a monolith. So there are some really strong performing healthcare pharma companies like Eli Lilly that have the Ozempic formula, and others that are not doing so well that don't. So differentiation is good. That's happening. This is why the churn under the surface, I think, is a really good thing and really positive thing for the market. It's not just tech and communication services leading the market higher. I don't really mention this too often, but there is, I think, a technical aspect to this, which otherwise is known as flows in some cases, where what you're seeing on the screen here is the NYSE advanced decline line. It just sums up in aggregate all stocks on the S&P. And if by numbers they are going up, the index moves up. If by numbers on a given day, a majority are moving lower, then the index moves lower. And so it's kind of a breadth indicator, meaning how widely distributed is the rally. And what you can see here is that the breadth indicator is telling you that the market should be nearing all-time highs because a majority of stocks are moving up at the same time. And this is a really useful tool. You can't use it, in every situation, but this was a really useful tool in identifying weakness ahead of the tech crash when we're really only technology companies were moving up in 99, 2000. And also a really useful tool in 2007 and 8 when financials were leading the market higher and everything else was starting to drift off. So we pay attention to this generally when the market gets very focused on a few sectors. But right now, what this is telling you is that there's a pretty wide participation. And in that way, you've got a nice technical bid to the market as well, too. Just one thing I pointed out previously, that is what was once a headwind in the form of Chinese stocks, now is probably turning into a tailwind. And would you be surprised to know that Chinese stocks now have performed better in dollar terms this year than the S&P? That it certainly was not the case last year, and really only recently has this been a phenomenon, but it also tells you how quickly things can change. And you can see as little ago as late January, Chinese stocks were down 12%, where the S&P was up maybe 5 or 6%. And now that's completely reversed with maybe the idea that China did let some property developers go into bankruptcy. Some of the banking system has dealt with some of the bad loans. Clearly, they've got much more to go. But I think this is actually a tailwind because, coming out of the financial crisis in 2009, Chinese equities led the way well before the S&P finally bottomed. And I think this is just maybe another tangential idea that if Chinese markets are going up, that it's not a bad thing. It's not a headwind for sure. And of course, we don't own any because property rights there are still very suspect. This is just our helpful reminder that political affiliation is a bad investment guide. And I do understand, I do see that, over this time series, Democratic presidential investment strategy did better than the Republican presidential strategy. But that's not the point. The point is that if you left your money in the market, regardless of who was in office, your outcomes were multiples better than either one of those strategies. So unless there are wide-ranging and sweeping changes to tax code, tariff policy, free trade policy, it's likely that president will have very little impact long-term on the direction of S&P 500 companies because there are very smart people that work at these companies that are evolving and adapting to business conditions that find a way to make money regardless of who's in office. So that's just, I think, the point of the chart, not that one is better than the other. We did touch on this earlier, but still a rocky start for the bond market that extends into the mid-year. And we think, while there are certainly higher levels of income that can be found in the bond market as the prices drop, I still think there is risk that is underappreciated, particularly in longer duration bonds. And again, I go back to the example of what happened in the UK last year, where just one bad budgetary announcement led to a massive drop in the bond market. I still think something like that is possible. And if it's possible, then we're better served staying fairly conservative, particularly because the short end of the bond market is still yielding higher than the long end. And in that way, we don't really have to take on a lot of risk to earn a very respectable return at the moment. There are pockets of opportunity that I would mention. Things like asset-backed securities, mortgage-backed securities in certain areas are part of the mix we have to generate a little bit higher yield, but we're not taking on any substantial duration risk at the moment, and nor will we until inflation looks like it's well behind us, or contained at least. And then finally, I just wanted to point out what is and has been working within the portfolios. Now, this is a position we don't own. I just have to make that disclosure. This is a proxy for what we call trend following strategies. This is an example of a liquid alternative. And this is an ETF that you could take a look at if you wanted to. But we find trend following strategies actually really attractive in this environment because generally they perform, exceptionally well when the market goes into a risk-off period, and that's because generally they're picking up on trends, particularly in currencies and fixed income and commodities, in advance of a major turn. That if you can position in advance of those major turns, you can benefit from majority of the return as the markets are going down. So this is a trend following strategy, is one of those strategies that generally shouldn't be working in an up market like we have right now, but it is, because there's a lot of differentiation going on right now between asset classes. And in that way, that gives us comfort that we'll be protected in the case that the market and the S&P decides to turn lower, but also we're not going to necessarily be losing money if the S&P is going up either. So it's one of those ideally suited, just like long short equity, that I think we have exposure to in our liquid alt sleeve, and we'll continue to own until conditions change pretty meaningfully. And one of those positions that can really help us if the market sells off, as it did in 2009 and 2018. You've been generous with your time. Here's just a few key takeaways, and I think we're right at time, about 35 after. Just a reminder, 24, this is not going to be a repeat of 2000. There's similar levels, yes, of concentration, a little bit of evaluation, overshoot for sure. But growth expectations this time around, I think, are very much different, and profitability metrics are much more healthy in 24 than they were in 2000. And I think the fact that we're actually getting differentiation, but not only between sectors, but also intra-sector, meaning where, one software company might be positive, another software company might be negative for the year. That type of differentiation really works in our favor as an active manager. And also, from an asset allocation standpoint, can allow us to earn returns and harvest returns when they become available, maybe easier than if it's just a beta trade or when the market's levitating up across the board. Now, is there, however, a great time to manage risk? Really is not a bad time to be managing risk, but with markets at all-time highs, my old saying is it's never a bad time to be taking profits, and that's exactly what we've been doing. We have gotten some pushback, of course, from clients for trimming back NVIDIA or selling some of our winners that have done exceptionally well. But I do like to remind people this is a forward-looking exercise as opposed to a rear-looking exercise in the investing world, and we've got to be mindful that if there are better opportunities for our capital, we will be proactive and take action. But it is, I think, a priority of ours to reallocate that capital to areas that can benefit from higher future volatility, because we are at low levels right now. We still have a liquidity preference for our fixed income and bonds. We don't want to be too aggressive seeking out return in the bond market at the moment. I still see a lot of people looking at emerging market debt or preferred stock as options, and I think those are very poor risk returns right now because you're just not being compensated for the risk that you're taking. There are areas to look at, like structured credit we talked about earlier, but EM debt, preferred stock, parts of high yield are not part of our opportunity set right now. And then I think after demonstrating really attractive diversification and return benefits in 22 and 23, alternative strategies, whether they be liquid or private market, have done exactly what we had hoped they would for the most part. Yeah, there are some areas that have underperformed, no question about it. But as far as providing us with diversification benefits, non-correlated returns that are positive during challenging periods for markets, we still find a lot to like there. As a reminder, we do a twice a year private markets update, one of which we just did in May. If you'd like a copy of that and you're an investor in our private funds, I would highly encourage you to take a look at that. Our portfolio manager in private markets, Jay Sands, has done a great job really dialing in the content there to make it more easily readable. So would strongly encourage you to take a look at that if you happen to miss that. Thank you so much for taking the time to spend with us this afternoon. We look forward to speaking to you again sometime soon. Thanks, everybody.